Ever wonder if the stock market is like a safe harbor or a treacherous sea in 2024? With all the buzz about economic roller coasters and geopolitical whirlwinds, it's the big question on everyone's mind. Is it time to set sail with your investments or anchor down? We're about to navigate through the choppy waters of stock market predictions for 2024, dissecting everything from economic undercurrents to AI waves reshaping the investment landscape. So are you ready to chart this course with us? Don't forget, hit that subscribe button to join our crew of market explorers, where we unravel the mysteries of finance together. As 2024 unfolds, the stock market is like a vast ocean full of both treasure and turbulence. Think back to 2023, the S&P 500 was a champion swimmer, but now, as we dive into the new year, it's a whole new game. We're not just splashing around. This is strategic swimming in deep waters. The stock market's mood swings faster than the weather. It's not just about the numbers. It's a psychological thriller with economic twists, global power plays, and the unpredictable currents of investor sentiment. Are we riding a wave of prosperity or paddling against an economic tide? Let's set our compasses and navigate these mysterious waters together, deciphering the signs, trends, and forecasts that will shape our financial journey in 2024. So grab your life vests. It's going to be an exhilarating ride. The economic landscape. Recession is the buzzword echoing in the alleys of Wall Street, reminiscent of 2008's chilling breeze. But let's decode what this means for our investment ship. Imagine your daily coffee costing more each day. That's inflation, sneakily lightening your wallet. The global supply chain is playing hard to get, still dizzy from the pandemic's lingering effects and tangled in a web of geopolitical rivalries. This economic breeze could either propel our stocks to new heights or capsize them. The IMF's crystal ball shows a global growth slowdown dipping to 3.2% in 2024. It's a signal to fasten your seatbelts and perhaps rethink your investment strategies. Are we facing a stormy sea or just a few ripples? The answer lies in how these economic winds blow and how well we adjust our sails to navigate them. Geopolitical chess game. In the stock market's game, unexpected moves are the norm. The ongoing conflict in Ukraine and rising tensions in the South China Sea are like high-stakes chess matches with global economic implications. And don't forget the U.S. presidential election, a political saga that could rewrite economic storylines. These scenarios are potential dominoes that could either topple markets or simply cause a flutter. Market volatility often mirrors the intensity of these geopolitical dramas. It's like balancing on a tightrope where one misstep can lead to a dizzying fall or a triumphant crossing. Understanding these geopolitical dynamics is key to predicting market behavior. Will these events trigger a storm in the financial markets, or will they be mere waves that seasoned investors can surf? The answer lies in closely monitoring these global happenings and the ripple effects on the world of finance. Riding the investor sentiment roller coaster. Recently, investors were riding high on a wave of positivity thanks to strong market performance. But clouds are looming on the horizon. Talks of a potential recession have some investors jittery, their fingers hovering over the sell button. Yet there's a silver lining. Despite these fears, many companies are still posting robust earnings, especially in the tech sector. Innovations continue to break new ground, offering a beacon of hope. It's a real roller coaster, folks. One minute, everyone's high on optimism, the next, they're ducking for cover. Investor sentiment is a tricky beast. It can fuel market rallies or trigger sudden drops. Keeping a pulse on this sentiment is key. It's like reading a mood ring that changes colors with the market's highs and lows. The new kid on the stock market block. It's not just sci-fi anymore. AI is becoming a major player on Wall Street. With this ability to crunch numbers at an insane speed and spot patterns humans can't, AI is transforming how investments are made. Algorithmic trading powered by AI is like having a supercomputer for a financial advisor. It makes split-second trading decisions, potentially raking in profits. But it's not all sunshine and rainbows. AI's impact has its shadows. It might replace some jobs, and there's always the worry about whether these algorithms are playing fair. And let's not even start on cybersecurity, a whole new battlefield. AI in the stock market is a double-edged sword, offering both incredible opportunities and challenges that need smart handling. The market correction. Now let's tackle the big, scary topic of market corrections. Think of them like the stock market's way of taking a deep breath. Yes, the very term can send shivers down investors' spines. It often means a drop in stock prices. But here's the twist. Corrections are pretty normal. They're like the market's reality check, cooling off things when they get too heated. Historically, these dips happen every few years. The key: don't freak out. Smart investors see corrections not as a disaster, but as a clearance sale. When prices drop, it's an opportunity to buy quality stocks at a discount. It's all about perspective, like seeing rain as either a gloomy day or a chance for growth. Remember, the stock market has bounced back from every single downturn it's faced, rising like a phoenix from the ashes. Long-term investing. Let's break down the art of long-term investing. It's like being the tortoise in that famous race, slow, steady, and winning at the end. This approach isn't about quick wins. It's about growth over time, like planting an oak tree and watching it tower sky-high years later. The ups and downs, they're just part of the journey. Look at the S&P 500. Over a century, its average returns around 10% per year. That's the power of sticking it out over the long haul. By diversifying your portfolio across various sectors and asset classes, you're not putting all your eggs in one basket. You're building a fortress that can withstand market storms. And let's not forget the magic of compounding. It's like a snowball rolling down a hill, getting bigger and bigger. The key is to keep your cool when the market gets choppy. Diversification. Now onto the lifesaver of the investment world, diversification. Think of it as your financial diet, just like you wouldn't eat pizza for every meal. Tempting as that sounds, you shouldn't rely on just one type of investment. By spreading your investments across different asset classes like stocks, bonds, real estate, and yes, even a sprinkle of crypto, you're setting up a safety net. It's like having a team of different players in a game. If one isn't performing well, another might be scoring goals. Diversification reduces the risk of your portfolio taking a big hit if one sector dips. It's all about balance. If the tech stocks are down, maybe your real estate investments are up. This approach smooths out the bumps on your investment journey, making it less of a roller coaster and more of a scenic ride. But remember, diversification isn't just about throwing your money in every direction. It's a calculated strategy. It's about finding the right mix that aligns with your goals, risk tolerance, and investment horizon. So is the stock market in 2024 a safe bet or a leap of faith? While there's no crystal ball, the signs point to both opportunities and challenges. Yes, the economic climate is shaky, geopolitical chess pieces are moving, and AI is reshuffling the deck. But remember, the market has weathered storms before and come out stronger. Diversification, long-term strategies, and a cool head are your best allies. Ultimately, whether you jump into the stock market pool in 2024 depends on your swim style, cautious paddle, or a daring dive. The choice as always is yours. Don't forget, if you found this insight handy, give us a thumbs up and subscribe for more financial deep dives. Till next time, keep your investments smart and your risks smarter.